All right, today we're going to learn the actual language of business. And no, I'm not talking about buzzwords or corporate jargon. I'm talking about the fundamental system that every single company on Earth uses to figure out what's really going on with their money. So let's just dive right in. Imagine this. You've finally done it. You opened your dream bookstore, and we'll call it Chapter 1. The place is buzzing, people are coming in, and you're ringing up sales. It feels amazing, right? It feels like a huge success. But here's the thing. Feeling successful and actually being successful, they can be two totally different things. How do you really, truly know if you're making money or if you're just busy? That is the million-dollar question we're going to answer. To get from the chaos of busy to the clarity of profitable, you need a system. You need some rules. And it all starts with one surprisingly elegant idea: the golden rule of accounting. Okay, first thing you have to wrap your head around is the business entity concept. This is so important. Your bookstore, Chapter 1, is not you. Financially speaking, it's its own person. So when you take your personal savings and put it into the business bank account, from the bookstore's perspective, it just got a loan from an outside investor, you. Keeping this separation crystal clear is the first step to making sense of it all. Next up is this beautiful little idea, the dual effect principle. You can think of it like Newton's third law, but for money. For every action, there's an equal and opposite reaction. Every single time money moves, it doesn't just do one thing, it does two. When a customer buys a book, that's not one event, it's two. The store's cash goes up, and its inventory of books goes down. It's this two-sided effect that keeps the whole system in perfect, constant balance. It's brilliant, really. So with that in mind, let's start building our core equation. The first piece of the puzzle is assets. It's a simple idea. Assets are all the valuable things the business controls. For our bookstore, Chapter 1, that's the cash in the till, all those books sitting on the shelves, the shelving units themselves, even the computer you use for sales, anything that has future value. Now, on the flip side of the coin, we have liabilities. This is everything the business owes to other people. Think of it as the business's IOU pile. This could be a startup loan you got from the bank, or maybe it's the bill from a publisher for that big shipment of new fantasy novels that just arrived. It's what the business is obligated to pay out. And the final piece is called capital. Now remember how the business is a separate entity from you, the owner? Well, capital is what the business owes back to you. It's your initial investment to get the doors open, plus any profits that you decide to keep in the business to help it grow. It's your personal stake in the company. And when you put it all together, you get this: the golden rule, the accounting equation. It says that everything the business owns, its assets, has to be claimed by someone. And there are only two groups of people who can claim it: outsiders, which are the liabilities, and the owner, which is the capital. It's simple, it's elegant, and it always has to balance. Okay, so we have our grammar, our core rule. Assets equals liabilities plus capital. But how do we actually write the sentences? How do we record that dual effect for every single transaction? Well, for that, we need to learn the two most important verbs in the entire language of business. And those verbs are debit, which you'll see written as DR, and credit, written as CR. Now, I want you to forget any other meaning you have for these words, like from your bank card. In accounting, it's way simpler. A debit is just an entry on the left side of a ledger, and a credit is an entry on the right side. That's it. They're just the tools we use to record those two equal and opposite effects we talked about. So, how do you know when to use which? Well, here is an incredibly handy little tool to help you remember: the dead click mnemonic. It's a lifesaver. On the left, for dead, to increase your drawings, expenses, or assets, you debit them. And on the right, for CLIC, to increase your capital, liabilities, or income, you credit them. Dead click. It's like your secret decoder ring for making sure everything stays in balance. Let's see this thing in action. So, a customer walks into Chapter 1 and buys a book for $20 cash. First step, what are the two effects? Well, the business's cash, which is an asset, just went up, and its sales, which is a type of income, also went up. Okay, step 2, apply our rule, dead click. To increase an asset, the A in dead, we debit. And to increase income, the I in click, we credit. So the final entry is simple: debit cash $20, credit sales $20. See, it's perfectly balanced, it just works. Now, recording these entries is great, but you can't just, make them up out of thin air. Every single transaction, every debit, and every credit has to be backed up by proof, by some kind of evidence. And this creates a paper trail that tells the complete financial story of your business. So, why all this obsession with paperwork? Well, in accounting, these documents are basically everything. They are the hard evidence that a transaction actually happened. They give you proof of what stage you're at, like, did you just order something or has it been delivered? And most importantly, they're the source material for every single entry you make in your books. The rule is simple: no document, no entry. Let's watch how this paper trail gets built with a real-world example. Let's say Chapter 1 is running low on a bestseller. So step 1, it sends a purchase order to the publisher for 100 copies. That's the official request. Step 2, a week later, the books arrive with a delivery note inside, confirming exactly what's in the box. Step 3, then the purchase invoice shows up in the mail. That's the actual bill. And finally, Step 4, Chapter 1 pays the bill. See? Each step generates a piece of paper, creating this clear, verifiable story for the whole transaction. Okay, so we've seen how to record all the little individual transactions and how to track the paperwork. But the real power of all this work comes when we zoom out. All those tiny debits and credits start to come together to paint the big picture of your business's health in 2 super important reports. And this brings us right back to our original question. After all that activity, all the sales, paying the rent, the electricity bill, did Chapter 1 actually come out ahead? Did it make a profit? The answer is found right here, in the statement of profit or loss. This report just summarizes all your income and all your expenses over a period of time, say a month. You start with your total sales, you subtract what the books themselves actually cost you to get your gross profit, and then you subtract all the other operating expenses, like rent, to find the final bottom line, your net profit. This report answers the big question: how did we perform? But performance over time is really only half the story. The other critical question is, what's the business's financial health look like at one single moment in time? What does it own and what does it owe right at this very second? And for that, we have the statement of financial position. It's just a snapshot of your business on a specific day. And hey, does that look familiar? It should. It's our accounting equation, just in a report format. It lists out all the business's assets, and then it lists out all the liabilities and the capital. It proves that our golden rule is still in balance, and it answers that second question: where do we stand? And finally, the last piece of the puzzle. None of this works if the information isn't reliable. A financial story is only useful if it's actually true. So the last step in all of this is making sure the system stays honest and the numbers are accurate. You see, this isn't a set it and forget it kind of system. It needs regular maintenance. Things like doing a bank reconciliation where you check that your records match what the bank says, and just finding and correcting any mistakes are absolutely essential. These routine checks are what ensure that the financial story you're telling yourself and others is the true story. So look at that. We started with the confusing chaos of a busy new store, and we ended up with a clear, balanced, and honest picture of its performance and its position. You now have the basic vocabulary and grammar to understand the universal language of business. So the question isn't just about a bookstore anymore. What about the company you work for, your own side hustle? What financial story is the world around you telling now that you know how to read it?